Hello and welcome back to the Market Lens. I'm joined today by AP's Chief Investment Officer, Cliff Walsh. Thank you for bearing with us after a COVID-induced delay to our first Market Lens of 2022. We're very excited to be back in business here. If you're looking to catch up on any previous Market Lens, you can find them on YouTube or in the Studio 454 video library. We're going to start today's Market Lens with a news or noise segment on growth versus value. In our view, in a forever low interest rate world, I like the growth stocks long term. A little more scarcity of growth is out there, and even though there's been an environment where growth stocks have significantly outperformed, that may be due to some secular types of moves and some major themes that we're seeing play out in the markets here. So, Cliff, do you believe the move to value is news or noise?
I think it's an opinion, and I think it's noise, but that's what makes a market, having these different views. Our opinion or our forecast is different. I think growth will be the better bet. I think maybe in the short term you see value continue to outperform. The downdraft in growth equities has been pretty significant, and that momentum might continue. But we see long duration bonds, having peaked for now. We saw them move up all the way to 1.9%. They're about 1.75% now and firming up. We think will continue to improve. On top of that, you have the economy, which we think is going to start to slow, so growth will become more scarce. So I think that's going to attract some investment to the growth sector, and you're going to see money move away from value. But I think a more significant shift will be, or should be, into emerging market equities as an opportunity at this point.
Yeah, I agree with you. I think there's many different segments of the growth market as well, and as well as many different segments of the EM market. Cliff, you talked about growth stocks moving down in a big way, but I see our advisors always asking about, let's say, the more thematic growth type names like ARK, which has even moved and accelerated on the downside more so than the broad-based indices. Now, when you look at EM, do you think that the place to be is more of the thematic e-commerce EM stocks or broad-based EM?
I think you can get opportunities in both. My basic view at this point is broad-based, but I think if you look at the opportunities there, they're significant regardless. One of the main things we're looking at is looking at small and mid-cap stocks in the U.S. To emerging markets. Historically, they have the same growth rates, same volatility, but you're getting much better valuations historically, and I think better growth prospects in the short term.
Yeah, thank you. Now, switching gears a bit into more fixed income to equity type asset flows, do you think money will move away from treasuries and into equities in the near future?
Again, I think that's an opinion. I think it's not necessarily our expectation. We've already seen that shift take place. I mean, I think the short position in the 10-year treasuries already shows you that people hate bonds at this point, and I think there are huge positive spreads in the 10-year compared to Europe. Europe is still negative. Japan is at zero. So I think from a relative perspective, there's a lot of opportunity to gain, interest from abroad for the 10-year. I think rates, are significantly better than the lower quality sovereigns. You've got Italy at 1.25%. You've got Spain at 0.6%. China's at 0.7%. So if you're a bond investor and you need fixed income, where are you going to go? Usually when everyone is saying something, the trade is over, and we think that might be the case with people looking for flows into equities from bonds.
Yeah, that's interesting. Retail investors tend to forget that mostly all the public information is already priced into these markets. So it's really about these future changes in expectations that's going to drive outsized returns going forward. Let's now switch topics and zoom in to today's Market Lens. In this edition, we're going to focus on the Federal Reserve. So the Fed dot plots, they show Fed members' expectations for future interest rates. Do you like this on the investment side to use for investment decisions?
Yes, I think you can use them to expect something else. Seriously though, long range dots, I think there's very little accuracy. I think short term there is some value, so there might be some value looking at what the Fed is looking at for March or June at this point. They're looking for rate hikes, so I think you could pretty much assume you're going to get at least one at this point. But the farther you go out, the less I think predictive it becomes, and the more volatility you're going to see. If you just look at where the Fed was last March, a year ago, I mean, completely different from where they're at this point.
Yeah, I think it does a great job of showing what people are thinking at a point in time, but as we've seen, markets move so quickly now, and that can change so significantly even on a month-to-month basis. So what do you think the Fed actions, reducing bond purchases and raising interest rates potentially mean for this economy?
For For the economy, I mean, I think with bond purchases, I mean, not much impact. I think it's more financial, market liquidity. On the interest rate side, you have the higher cost of money. Money makes the world go round, as you know. So I think that with higher rates, you're going to start to see pressure on the economy, potentially pressure on the housing market. You're going to see commercial real estate backing up. Business spending could take a dip down. So I think it's definitely more significant on the rate side to impact the economy than on the Fed balance sheet side.
Yeah, a lot of pressure on the Fed right now. It's really all the talk out there is talking about what is the Fed going to do and when will they do it. So what do you think, and what do you think it's going to mean for the market?
From the bond purchase side, as I mentioned, our lack of the bond purchase side is certainly going to be less liquidity, so that's going to be money flowing out of the markets and likely out of risk. So we're going to see some stock selling, and I think we're just going to see overall less risk-seeking behavior because the Fed is no longer providing that liquidity. From an interest rate perspective, still going to see some impact. I mean, bonds are going to become more attractive. I think you're going to see less M&A. You're going to see less share buybacks because companies have been using cheap money to do those deals.
Yeah, so going back to the dot plot here, as of now, late January 2022, the market is pricing in 3 to 4 hikes for 2022. In the short term, like we said, it tends to be accurate, but I'll set the over/under here at 2.5. And what do you think will end up happening for the total number of hikes in 2022 here?
Well, I have lunch with Lon, bet on that. A couple months ago, I thought we would push at about 2, 3 he would win. So I'm leaning a little closer to him winning, but I certainly don't expect to see 4. And I think we may see the Fed raise once or twice and then take a look at what's going on. And to be honest with you, I don't think it's going to be that great because I think inflation is being misjudged. We have it's more of a supply side shock than demand driven shock, which means that these things are not going to be impacted by change in rates. It's more a change in the supply chain and getting people back to work in factories and whatever. Even if you just look at what happened with the CPI, you have used car prices, new cars, rental cars, all up 30+%. Well, actually, new cars are up 11%, but used and rentals are up over 30%. You've got meat prices up double digits. Processing got hit really hard in the pandemic and the downturn. So I think the interest rate issue is not going to affect inflation that much, but we're going to see it come down naturally as these issues work itself out and the comparisons get easier.
Yeah, wouldn't be a market lens without some bacon inflation conversation.
Absolutely, yeah. Look, unfortunately, the processing industry has been hit pretty hard by COVID. It takes some time to work itself out, but with less supply, prices have gone up, and I think it's just going to take some time to work itself out. So I think at this point, 3 or 4 in a year, as the Fed is looking at on the dot plot, I think it's going to hurt the economy, especially when you look at the tapering that's going on. I think the Fed could raise twice and pause. If we do get that 3 or 4, I think they're going to be quick to reverse. I think it happened in 2018. So whether it's 3 or 4 or 2 or 5, what matters is if it's the right medicine for the problem. And I think the Fed is going to have to end up giving too much medicine, and it's going to be an issue for the equities this year. Hopefully I'm wrong and they only do 1 or 2 and they pause, but my concern is that they go longer.
Yeah, we've talked about it a lot. The Fed is in a precarious position, potentially setting themselves up for a policy mistake, but we'll wait and see what happens. So thank you everyone who joined us. We hope this is letting you see 2020, and we hope to see you next time. Take care.